Upbeat music starts and fades slightly.
Have you ever wondered what actually happens when a company makes a huge sale, but then the customer never pays? It's a really big deal, not just for the company's bank account, but for how they report their financial health to the world. So today, we're going to pull back the curtain on the clever accounting method that keeps the books honest when credit sales go bad.
So here's our game plan. First, we're going to dig into a super common accounting trap that can make a company's profits look way better than they actually are. Then, we'll get into the elegant solution that accountants came up with to fix it. We'll look at exactly how they estimate future losses and what they do when they finally have to give up on a debt. And to wrap it all up, we'll put all the pieces together for a quick review. Let's jump right in.
All right, let's dive right into the heart of the matter. I mean, think about it. Selling on credit is fantastic for business. It boosts sales, gets product out the door, but there's always a catch, right? Some customers just aren't going to pay. And for an accountant, oh man, the real headache isn't even that it happens. It's when you're supposed to record that loss. It turns out timing is absolutely everything. Okay, picture this. In year one, a company has a massive sales event. Revenue is through the roof, and their income statement looks amazing. But here's the thing. The cost that's hiding in the shadows, all those customers from that sale who won't pay, doesn't get recorded as an expense until year two, when the company finally throws in the towel. And what you get is this totally wacky picture. Year one looks artificially profitable, while year two gets hammered with expenses from the previous year. That, right there, is the mismatching problem in a nutshell.
So how in the world do you fix a mess like that? Well, accountants, being the clever people they are, came up with this really elegant solution. The whole idea is to do one simple thing: match the pain of that bad debt with the gain from the original sale, and do it all in the very same accounting period.
And it's called the allowance method. You know, the idea is actually super simple, but it's also incredibly powerful. Instead of waiting to find out exactly who is going to flake on their bill, you make an educated guess, an estimate, of the total amount you expect to lose from all the sales you made in that period. It's kind of like setting aside a little money for a rainy day before you even see the clouds. This makes sure that the cost of those bad debts gets reported right alongside the sales revenue it helps generate.
All right, let's make this real with a quick example. Meet Bart & Co. So at the end of their very first year in business, their customers owe them $278,000. Based on what they know about their industry and maybe some early trends, they make a little estimate. They probably won't be able to collect about $3,000 of that.
Okay, so how do they get this estimate onto the books? With a journal entry, of course. They record a $3,000 expense called credit losses. Then they put that same amount into a special account called Allowance for Expected Credit Losses. Now, this allowance account is the key to the whole thing. It's not tied to any one customer, it's a general reserve, that rainy day fund for all potential bad debts. It's what we call a contra asset, which is just a fancy way of saying it hangs out on the balance sheet and lowers the total value of their receivables.
And here's what that actually looks like on the balance sheet. It's pretty cool. You see the total amount owed, the big number, $278 grand. But look, right below it, they subtract that $3 grand allowance. The number that's left, $275,000, is called the carrying amount. This is the real number, the honest number, the amount of cash the company truly believes it will collect. For anyone looking at these financials, this is a much, much clearer picture of the company's health.
Now, you might be thinking, this whole thing seems to depend on making a good guess, right? And you'd be absolutely correct. The entire method hinges on a solid estimate. So how do companies actually come up with that number? Well, there are basically two main ways to go about it. One simple and one a lot more detailed.
First up, you've got the simple and sweet percentage of receivables method. You just take your total receivables and apply one flat rate, say 2%. It's super quick, super easy. But then you have the much more sophisticated aging of accounts receivable method. Here, you break down all your receivables into buckets based on how old they are and apply a different risk percentage to each bucket. Yeah, it's more work, but man, it's way more precise.
Let's really dig into this with another example. Say hello to Abrams Furniture. We'll start with the simple percentage method. They have $200,000 in receivables, and they figure about 4% will go bad. Now pay attention to this little detail right here. Their allowance account already has a $1,000 credit balance in it from a previous period. That's important.
Okay, so the goal here, the target for our allowance account is $8,000. Simple math. 4% of 200,000. But, and this is a really important but, they don't need to expense the full $8 grand. Why? Because they already have $1,000 sitting in that account. So the adjustment is just for the difference, $7,000.
That entry tops up the account to get it to our $8,000 target.
And you can see exactly how it all works here. That initial $1,000 balance plus the new $7,000 we just added gets the allowance account right where we want it, $8,000. We subtract that from the total receivables, and that gives us a much more realistic carrying amount of $192,000.
Okay, that was the simple way. Now let's get way more accurate using the aging method. Just look at the schedule. It's awesome. It takes that same $200,000 and breaks it all down customer by customer into categories based on how late their payment is. And notice how the risk just skyrockets? It goes from a tiny 2% for current accounts all the way up to 50% for those really old debts over 90 days. I mean, that just makes sense, right? The older a debt gets, the less likely you are to ever see that money. So what we do is we multiply the amount in each bucket by its own unique risk percentage. Add it all